Hey everyone, I'm Mitchell Hora. I'm a farmer from Iowa.
And I am Zach Johnson. I farm in West Central Minnesota, and this is the Fieldwork Podcast, which is by farmers, for farmers. Every single episode, we talk about what works and what doesn't in sustainable agriculture. Thank you very much to the Walton Family Foundation for their support this season.
So today, Zach, we're going to talk about banking. And for farmers, having a great relationship with your banker is super important. So today we're going to talk to Marc Schober. He's a guy whose job is to figure out what works and what doesn't for the ag banking industry. The whole thing really boils down to that if the bank can help farmers to find better technology, that they can overall reduce risk and help their farmers to be able to ensure that they have long-term profitability.
It's an interesting way to think about banking, honestly. You don't hear that a lot from somebody within the banking industry. And Marc works for Bremer Bank, which is actually currently the 9th largest ag bank in the nation.
We need to let you know that we recorded this before Bremer Bank became a sponsor of Fieldwork.
It's always fun when that happens because it must mean that the guy from the company didn't run away screaming in pain after he talked to us, right?
Yeah, that's a good thing. Because, we've had that a lot. That might be where Oprah's at. Maybe we should check on that one.
I'd be interested to talk to them more about potentially financing our coconut crop.
And ensuring that we have a helicopter because we need transportation to get to our coconut crop.
Yeah, otherwise, how you going to scout your fields or your beaches?
We better get into our conversation here, Zach, and see if we can get that snuck in here.
He's going to be surprised to learn that I actually love talking about banking.
Let's do it. Let's talk about banking, and you can ask the first question.
The first question? Well, first we should probably say that we got Marc Schober with us here from Bremer Bank, and his title is the Director of Specialized Agriculture Solutions. Did I get that right, Marc?
That's right.
Awesome. So tell us a little bit about what that involves and what it is that you do with Bremer Bank.
We have ag bankers spread out across North Dakota, Minnesota, and Wisconsin, and my role is to seek out new solutions for farmers or internal solutions that revolve around agriculture. We didn't have a call it liaison between all the ag bankers, so when I joined a couple years ago, that was part of my role, and certainly live in the strategy space at the same time. So although I help all of our bankers do their jobs better, I'm actually technically not a banker, but I work for a bank, and I do anything ag for them.
Okay, so what do some of those solutions look like when you talk about seeking out solutions? What does that mean exactly?
It's tough. The ag tech space is so wide. You can easily get caught wallowing in the waters of ag sensory solutions or real-time data capture, which are amazing and powerful. Then I have to come back and sit at my desk and think long and hard at, all right, this is a pretty cool solution. It may help farmers make in-time or in-season decisions better because they, for example, know exactly what their input costs are or know exactly what their output prices are. How can I integrate this? So that's kind of the $1 million question that often occurs. But I take a look at anything because if it is monumental on a data collection solution that can help a farmer make a decision if they should spray for aphids or not, that does trace back to my original purpose of trying to increase profitability on the customer side, because if yields are going to be higher and the ROI on that aphid application is there and strong, it in turn should decrease credit risk as well. I look at farm management systems, livestock management systems, any sort of data collection, soil sensory, remote sensing, real-time sensing, insurance solutions. Like I said, what I thought was pretty interesting just in the last maybe year or so that's picked up a little bit is kind of the overlap of ag tech, fintech, and that's one that obviously a bank probably has the smoothest road to trying to take to market.
So as you're looking at some of those solutions now, what's some of your primary focus on what your farmers are asking for or what you guys are looking at bringing to the table? Like, are there some specific needs that you're looking to really fill at this point in time?
Sure. Good question. The solutions that I'm looking for are broad, and we're going to take this up like 30, 40, 50,000 feet. I'm looking for anything that will help increase customer profitability. So on the ag side, any ag customer inside the farm gate or outside the farm gate. And at the same time, chances are that will decrease bank risk. And then I'm also looking for anything that's going to create efficiencies for customers or internally on the bank side. So that can be really a very, very wide array of different types of solutions. I live heavily in the ag tech space, seeking out new innovation solutions. So thinking of very cutting edge solutions that that farmers maybe haven't really come across yet, or agribusinesses haven't come across yet. With that side, it's always difficult to think about how can a bank play the role of connecting the dots, and then also really is it the bank's role to play in that ag tech space. And a lot of these solutions also have carryover into different aspects of the bank, like crop insurance, for example. Bremer has crop insurance advisors throughout the 3 states, and there are many different solutions that can help that. For example, it can get as niche-y as well. Does this type of crop or does this type of solution potentially help potato farmers, for example? We have quite a few of those in our portfolio, and we can kind of focus in and bring some of those customers in to bounce some of these ideas off of and see if this is something that Bremer Bank should really play a role in bringing to quote unquote market.
So playing off of that, do you have a specific customer or what a specific customer looks like, a typical customer for you and who you work with?
We probably don't have a typical one internally. We have a few examples, but we have as diverse as sugar beet and potato farmers that are extremely large scale. Our footprint's interesting. I mean, the average farmer in North Dakota is in the thousands, and then you get down to the valleys of Wisconsin, and you're in the low hundreds. We have all of those inside. We have very small dairies. We have very large dairies. We have really anything in between. So our average farm customer is one that is forward-looking, doesn't really have a size attached to it, but is somewhat progressive and open to really growing with a bank like us. That's summarize it. A little cheesy, but honestly, that's it. You need a forward-looking, progressive farmer, and that's my favorite type of customer. There, those are the ones where I kind of argue with the bankers. Make sure you bring me in. I want to meet them.
Are there other banks that are kind of doing the same type of thing? And then, what's been, I guess, kind of a success story here that Bremer has been able to really bring to the table and scale out through your network?
Yeah, certainly other banks are looking at playing in this space and helping their customers. I mean, I think every bank that has some sort of ag portfolio that understands the 12-month cycle for a farmer is trying to make their lives easier and make their bankers' lives easier, and create some efficiencies. So we are a part of some startup tech accelerators, and most of those are totally open innovation and are housed by other financial institutions as well. Ag tech probably isn't as focused on from the banking sector as, for example, just straight fintech or cybersecurity or things of that nature. But other ag banks are definitely looking at this space, and I'd say for the most part, we all get along quite well, because we're, as you guys know, in the agriculture community, yes, there's competition, but at the same time, typically what's good for one is good for all, and we're sitting here trying to get agriculture to thrive all together. Bremer has our purpose of cultivating thriving communities, and that truly does incorporate everyone in the community, even if it is other ag banks. For a success story, that's a good question. As I was kind of alluding to, I get caught trying to think about how we roll these things to market. I think one that has some good legs, a solution would be on the marketing side, trying to get better prices for farmers. If we come in as a trusted advisor and are able to make recommendations or advise our customers at getting connected up with marketing firms that we have vetted in some way, shape, or form, that's a way that we can add value. Now, we certainly don't require this, but our customers that have us sitting on that short list of trusted advisors with attorneys and accountants usually take our recommendations heavily, and we've had some really good traction on the marketing side of things. One that I just saw that came from the Midwest too is just a different way to value iron, and I thought that was very intuitive, very efficient, very easy to use. I'm going off on a tangent here, but if I had to summarize my favorite ag techs in one word, I would just say simple. And this one that values iron is super simple. Getting overcomplicated. First subsector I mentioned was farm management systems. Talk about a segment that got way too complicated. The ones that have good traction are simple ones. You can always layer on solutions over time, but hope that helps.
That's kind of leads me into my next question here. Maybe this is because I'm a farmer, but I feel commonly like there's so many tech companies out there and there's so much going on within ag tech right now, and everybody's coming at us saying, try this, try that, take this data, manage your farm this way, use this software, try all these 300 different tools that help you to micromanage everything. None of them take into account the fact that I still have to get everything else done. I can manage all I want, but at the end of the day, Dad and I got to be out there driving tractors and turning wrenches sometimes. So do you ever feel overwhelmed by so much tech coming into the space, and yet you have a difficult time trying to prove to not just your customers, but also to you, whether or not that tech actually provides a good value for the farmer and a return on investment?
That is spot on. It's like, when I go into evaluation mode, I'm purely acting as a farmer, and nothing grinds my gears worse than a solution coming from Silicon Valley, from a team that has never been to Iowa, Illinois, or Indiana, and has no clue what a spacing on corn and soybeans should be, and they're trying to tell me about a solution that helps strawberries or blueberries or vineyards. Those solutions work really well out there first because those are high value crops that you can prove an ROI quick. I love when these solutions come to the Midwest, because if you can prove it on corn and soybeans that have, these are successful farmers, are margin farmers on corn and soybeans. They're not just boosting yields to boost yields. They're trying to boost margins. If you can win that customer over, sign me up for series, B, C, and D after that, because that's going to be the larger customer base. A portion of that frustration really spilled into Bremer's role in trying to bring one of the tech accelerators called Plug and Play into the Midwest. We're a part of that one in a food and beverage vertical in Silicon Valley, and it was great. But a lot of the solutions coming from there just weren't trickling down to our customer base in the Midwest and in the Corn Belt, to be specific. So that office opened up in Fargo, which is just a great place, kind of on that cusp of where really seed genetics are taking off. Let's expand the Corn Belt north and west, and not really a better place to call home than Fargo. But yeah, I that is very difficult for some of these solutions to make sure that they are going to have a strong ROI on corn and soybeans. If they do, it's great. If they don't, as Midwesterners know, there's not a whole lot of watermelons being grown here. I don't know if that solution is going to be the right one to take off. Probably just want to keep that to one or two states.
I want to switch it here too. There's a lot of pressure, it sounds like, coming from the new administration coming in here as well, to the banking system on being able to push on investing green and stuff. And I just got off the phone with a local farmer here that his bank, through the farm credit system, is saying, hey, we got to be reporting on what we're doing for green and investing green, and what that means, I don't fully know. And that's what, hopefully you can answer that. But what are you seeing on that standpoint? So not only pressure for helping the farmers, but political pressure here too.
Yeah, that's a good question. I mean, we're early in the new administration, obviously, and I spend a decent amount of the mornings trying to read up on and then decipher speculation versus reality. But there's definitely going to be a push to go the green direction, and I think specifically, if I were to pick one thing that probably garners the most monitoring, it's going to be the carbon markets, and see if one actually is established that is going to be successful here in the U.S. From a banking standpoint, I mean, that it's funny. I kind of sound like a broken record, but I sit here and struggle with what we need to strategically pick what role the bank plays in that. Now, do I want to go all in and say line up all the incentives for our ag customers to make it as cheap as possible to work with Bremer if they check 99 out of 100 sustainability or regenerative boxes? Probably not, but some sort of happy medium is probably the right place to go. From a federal government standpoint, I think time will tell. I'm more of a somewhat reactionary position on that, just because I want to wait and see, make sure I'm not spending resources I don't need to spend. But I think from a bank's role, everyone is in long-term sustainability and regenerative practices, including the banking system. So I also, you could say this is contrarian, but I let subject matter experts do what they do best, and I know farmers know how to farm best, and I think we all know that the farmers don't deliberately do practices to release carbon, but at the same time, if there's a way for a banking industry or other commercial industry to help mend that gap to sustainable practices by having some sort of incentives, like a carbon market, for example, that's probably very doable. I mean, we're looking at the ethanol market. I'm a firm believer that corn-based ethanol is probably not the 50-year solution, but that was the solution to get car manufacturers and consumers to understand what ethanol does. And before cellulosic or other types of ethanol maybe are the answer 30, 40 years from now. But I don't see huge risks.
So I want to keep pushing on this in terms of what is the bank's role in sustainability and how are you guys approaching it? Because I think with a lot of these things, the bank is trying to help that farmer to be able to, ensure that they've got the capital to invest. But the nature of it is they have to be fairly risk adverse. But in adopting some of these sustainability things, the farmer has to change and they have to do things that are different and are new to them. So what is your angle, I guess, on managing that risk and helping farmers to be able to overcome the risk, not only financial risk, but there's a larger risk at play here too.
Yep. And I think that really Bremer is a little more than average, probably a little more forward looking on the credit side of things from there, because my parallel that I draw to this would be transitioning to organic. It is tough to walk into your banker's office and say, I'm going to transition over to organic. Do I have your blessing for 2 really rough years in hopes that I'll still be your customer in that 3rd year when I'm knocking the cover off the ball? I see somewhat of the same some of the same path on regenerative or sustainable practices that call it investing in green. The bank's role there is just as an entire industry, the credit department's got to be nimble, and there is weight that goes into the character of your customer. And I think we all know certain customers will do quite well to pivot into some of these sustainable practices, and at the same time, banks have to be risk adverse, but they can somewhat invest in their customers as well. And they can be there to help guide them in some of these sustainable decisions. I mean, right now, I got a list that I'm trying to make that would be call it acceptable, sustainable ag techs to partner with, so that if a customer does come to me and say, or instead of sustainable regenerative, hey, Mark, my farm's 3,000 acres. I want to really focus on these 1,000 acres to be some sort of regenerative practice, so that if there actually is a stamp one day for regenerative, I'm ahead of the curve. Help me I can absolutely help that customer do that. So I see it more of a guidance role rather than a full-fledged leadership role. I guess I'd put it that way.
Do you have any examples of customers that have had a tough transition, whether it be to organic or regenerative or anything? Maybe it's changing crops, whatever it might be. Examples where, say, the bank has been hesitant to give them the blessing to do this, but everything turns out pretty well after 2, 3, 4 years?
Yeah, the extreme example I can come up with is industrial hemp. That's one, call it a new crop. Some growers get excited by looking at the bottom lines of like industrial hemp for CBD production. There's a lot of labor that goes into that, but that has been a success. And that's where I know other banks too, if a farmer wants to start growing industrial hemp for CBD production, you probably aren't going to be flipping dozens of acres. You're probably flipping like 1 or 2. Last year and the year before, that was a major credit investment from the lender to let a customer flip to that, because the inputs are high, the outputs can be high, but your risk of loss is astronomical. So I think that's a good example of testing the waters of, all right, this is getting out of our quote unquote comfort zone. If this works on 1 or 2 acres, let's try to take more in the future. But I'd say industrial hemp's the top one that comes to mind. Some of the other ones, to go back to organic and transition, that's probably the other ones that you see quite a few success stories. 10 years ago, that was I feel like your only option to transition was to sell your transition crop at conventional prices. Now you're seeing niche markets pop up. You're seeing non-GMO soybeans, absolutely, in the last 5 years. You're seeing some commodity handlers, like I know you guys had Pipeline on in the past. Some commodity handlers like Pipeline trying to give some sort of premium for transition crops. You have some of the big CPG companies trying to do the same things. So I think that's also helping mitigate the risk. Where I'd also see this going forward would be on the regenerative side or sustainable side. As those practices pick up, lenders will become a lot more open to supporting those decisions and helping make those decisions for a farmer if there's some sort of hedge of risk on the other side. So for example, on regenerative, if you have an offtake that is connected with a CPG company that has the consumer base that's really trying to pull the label on the back of the box to tell you what practices were done for growing that specific crop on that farm, and the farmer could ultimately partake in the upside there, that would help the lender's standpoint astronomically for diverting risk.
So yeah, it's really having that whole plan put all the way together on, here's what I want to do, here's how I'm going to get paid, here's how I'm avoiding risk. But what else, what are some of the other pressures that Bremer or just the banking industry overall is getting to, not only helping that farmer or looking at risk in terms of the bank obviously has to continue to make money and continue to, invest smart, but what are the pressures around like social impact investing or, some of the things like that too? Some of these other things that are a little bit tougher to quantify than dollars.
Yeah, no, you're right. There are some other outside pressures on the banking industry like that. The whole concept of I forget what the term is, but it's something like do good or act good investing funds. And some of them have real power, really, really strong power. And actually really nice track records. I've worked with a few in the past. They do really well, which is super exciting. From the bank standpoint, if it is a depository bank, you are responsible for protecting your depositors, which are also your customers, and that's the money that you're ultimately lending out. Little different on the farm credit side, but I think the morals are well aligned. So yeah, it's just certainly is some outside pressure there, but if it is an entirely new crop, for example, the ultimate risk mitigator for a lender is U.S. crop insurance, hands down. So if we can offset a portion of the risk on the U.S. crop insurance program, the light gets a lot greener, even if it's really outside the box for a farmer. If there is a T yield, or if there's a beat on becoming a T yield at some point, or if farmers have some success in the area, I don't know if I want to walk the path of a third-party crop insurance, but maybe. I think that U.S. crop insurance is really the ultimate risk mitigation of, like you said, Mitchell, a farmer comes in, has a plan. The banker certainly has a role in helping sharpen the pencil on the plan, and maybe making introductions and playing that advisor role of saying, your price potentially could be higher here if we make some introductions to new markets, or your inputs might be cheaper here if you ever heard of doing this. So that's kind of the role of the lender in that situation. But ultimately, crop insurance is the first risk mitigation tool out of the box.
Do you think crop insurance, or anything else for that matter, might look different now as we go forward with the new administration? What might be changing?
I would be cautious to say that's going to change much. I'd almost want to ask the farmers the farmers that I talk to, that's the last thing that they hold closest to their heart is U.S. crop insurance. And as we all know, story after story after story around the world of, mass warfare sometimes stems from or actually often stems from food scarcity. And the U.S. crop insurance program, albeit that subsidy of 50 to 60% of premiums, depending on, somewhere in that ballpark, really helps the U.S. farmer stay in the game for at least another year in a tough situation. That doesn't exist in other countries, and that's what leads to sometimes very drastic situations. So do I see changes to that? There absolutely could be tweaks. In my opinion, probably for the better. You're seeing a lot more crops jump on the T yields, or first-time T yields in a county. Industrial hemp, for example, that's expanded drastically. You're seeing corn and soybeans pop up in new counties in the Dakotas further west that have, 10 years ago, people would have laughed you out of the room if you would have said there would have been a soybean T yield out there. So I think that things are certainly improving. Do I see any major changes there? Probably not, just because that is, if I were a farmer, that'd be the last item on the federal agenda that I would probably want heavily tweaked.
I think one of the things there, though, is how to integrate some of these more innovative components on sustainability. And yeah, I mean, we've been directly in on this on our farm too, that in 2020, we raised mustard and barley and rye. And yeah, there's no T yield for that. And we took on 100% of the risk ourselves. But even some of the things like farmers planting green, or relay cropping, or interseeded cover cropping, or some of these systems that can really help to sequester a lot of carbon and can really improve soil health in a short amount of time. Our crop insurance guys are like, I don't know about that. So what's your thoughts there? How do we just continue to show here's what we're doing and here's why it is risk adverse? And for overall crop insurance, how do we show here's how we're being innovative and support us?
That is a excellent question. Excellent point. I mean, the parallel there to T yields is pretty strong. It's if no one's ever done it, RMA is probably not interested in getting rid of the risk. If one or two operations are trying it, then that goes into a different box. And that's where I see the role of potentially co-ops even. It really helping drive that. So I absolutely see value in all the practices that you just laid out, Mitchell. And a common one for especially the operations up north would just be cover cropping, or keeping the soil covered in some way, shape, or form throughout all 12 months of the year. I could absolutely see U.S. crop insurance incorporating the value in that. I think it's going to take a little more adoption, and I'm sure they're going to break it down to a county level. But as you said, growing mustard and jumping into the pool first, is fantastic, and it ultimately helped everyone else in your county as you did that, and even the adjacent counties. But I think we're going to see more and more of that on the cropping practices. It just is going to take a little time for a few of the kids to jump in the pool first. That certainly is something, though, that even from a lender standpoint, I need to be very aware of where some of those trends are happening so that we can advise customers or be aware of customers who are the ones jumping in the pool to try to help this thing move forward. I totally could see RMA valuing some of those practices. Probably not tomorrow, but it could be relatively soon. I would hope so. I mean, you guys know those practices aren't necessarily free. And yes, they have returns, but sometimes it's not next month. It would be nice to be able to hedge away some of that risk.
All right, everyone, we'll hear more from Marc Schober after a short break.
In this next part, you're going to hear us talk a lot about RMA. And for those who don't know, RMA stands for Risk Management Agency, which is part of the USDA. Back to our conversation.
A lot of those people that are jumping in head first are our listeners. Any quick advice on them beyond talk with your local crop insurance person and your local banker or whoever to say, hey, I am doing something different, beyond just call your local guy and ask them for help?
That's a good question. In my experience, it's partnering with the right crop insurance advisor. I always, if there is one that has a strong relationship directly with RMA, that does go a long ways. Because RMA, you may think being a government organization maybe has ears closed. They don't. They actually are open to trying to improve the process and expand the program as efficiently as possible. So I've worked with crop insurance agents in the past that have talked about cropping plans that have been somewhat one-off and directed them to RMA, and actually had conversations directly with RMA, with the grower, to talk about these and try to extract the value. So, certainly get in touch with your crop insurance advisor and see if there is a path to RMA. Otherwise, trying to get some sort of path to RMA directly is probably an acceptable route as well. And my other tip on that too is, just be conscious of how big of a jump you're taking into the pool. Like on hemp, one acre or so is probably a great start. Or if you're growing a non-insured crop, a few acres to test it out. If everyone's lucky enough to have their own back 40, that's a great testing spot for it. Another spot as well would be a relationship with somewhat of a local university. I know Iowa State's ears are usually open to helping in that function of new cropping programs or new farming programs. NDSU is another good one for that front, because they obviously have a different type of path to people like RMA or others as well. But between those two, networking of telling others that you're doing, telling others of what you're doing is also probably important. That really should probably be the third point, because like I said before, you're not directly evil enemies with other growers in your county. We're kind of all in this together. And if something's working on your farm, chances are the soils are probably similar to some of the other neighboring farms. You may want to share that information. And maybe the feedback you're going to get is, actually think about tweaking that same practice just a little bit further to the left, because I'm doing it that way and it's yielding better results than what you're doing. So I'd be vocal about it. I wouldn't be overly secretive about some of the first time tests that you're running.
So I'm going to shift gears on you a little bit here, and I'm going to bring up yield versus profitability, which I'm sure is something you deal with a lot. And I
Never heard of it.
Never heard of it.
No.
Yield or profitability?
No, both. Neither.
Either one. I think it's changed a lot, particularly in the last 5 years, as margins were really, really tight for farmers. And I think there's a new mindset looking at profitability versus yield. Do you struggle with that with some guys, where guys still have the mentality that they need to see the biggest yield all the time, and they struggle with putting together the full cash flow and seeing the whole picture of profitability versus what that big yield might cost you?
Zach, if it's not 300 bushel corn, it's not even worth it.
Yeah,
You're from
totally
Washington, Iowa, Mitchell.
Yep. It's I could talk for a long time on this. Not unfortunately or fortunately, people have caught on in the last 5 years of yield versus margin. And my spiel on it is, there's certainly two trends of farmers: yield farmers and margin farmers. Those aren't polar opposites with a force field between them. There's a blend, and you could be 1% one direction, 99 the other, and anything in between. So on a farm of 10,000 acres, for example, that has different types of offtake contracts in place, they may be pushed towards generating higher yields than a smaller farmer who maybe doesn't have as advantageous of offtake agreements in place, because the larger farmer is going to get a higher price per bushel on any additional yield per acre over X or something like that. That's getting kind of complicated, but that's the far end of the spectrum. Do I see an issue of farmers not understanding yield versus profitability? No, I think they do. They're doing a really good job of understanding that now, because with all the different solutions and farmers getting hounded constantly by input providers of saying, try this, try that, I'll give you a few gallons free, just give it a whirl and try to get you into the program. Everything has to be adjusted to prove some sort of ROI. And usually that's not directly correlated to only yield. I mean, some successful farmers don't have 300 bushel an acre corn. They have very cheap inputs, and they're only pushing, slightly over county average. And they're focused somewhat on some sort of risk mitigation on a marketing plan. I'm a huge advocate of that, especially in today's markets. Holy smokes, you could offset some risk there. But having cheap inputs and average yields could get a stronger bottom line than just strong yields, super expensive inputs. I think we saw this sometimes on some of the twin row planted corn in the beginning. That was worked really well if you could manage your nitrogen prices, and you could really side dress nearly nonstop. But if you lost track of your nitrogen prices on that operation, you could get smoked. You could still grow 280 bushel corn. You could have the bins bursting at the seams, but your input prices could fall out of whack really fast, and then your margins are tipping the wrong way.
I think part of this to me, is as you're looking at that profitability in the bottom line, and whether it be by wanting to reduce inputs or fine tune some of those things, part of that is a multi-year process to be able to really get there. And one of the concerns that a lot of growers have is their operating note is an annual operating note. Any thoughts on, any movement on that arena where, maybe the banking industry could offer growers longer term operating notes with saying, hey, this is going to be a 3 or a 5 year program to really be able to get this profitability to work?
Absolutely. That would be a direction that not many lenders have gone, but I would be an advocate of that, or I guess I am an advocate of that, of trying to look at a bank's credit risk for a customer a little differently, especially on new practices, because if a lender is truly a partner to the operation, being an inhibitor of incorporating those types of practices, that somewhat contradicting. So at the same time, you don't want to be a catalyst of making the wrong decision or pushing them down a wrong path. But I would imagine lenders are going to somewhat change the makeup of the 1 year operating loan in some capacities. Maybe it's 20% of that falls off and goes into a special 2 or 3 year loan, because we could all see, for example, land rents maybe are something that'd be fitting to stay on a 1-year note. But I could see there being maybe a hybrid of something that's annually and then something that's done every 2 or 3 years or something like that in a special situation. Some lenders have tried to do that and partner with offtakes to try to decrease that risk. Partner with an offtake that is going to guarantee some sort of higher price for that farming practice, and then the bank isn't taking all of that risk if there's a contract in place on that farm for getting a higher price for that farming practice, or maybe for that specific commodity. I think there could be some revamps on the structure of operating lines of credit like that. It's a very good point.
What about the interests of farmers versus agribusinesses? Do you find that those positions are aligned or opposed when it comes to making changes?
Some are very opposing and some are totally aligned. I've seen both. Sometimes on the agribusiness side, that's just a barrier to entry in the industry is to not change anything because they have somewhat of a lock on the process. I see that probably getting less and less over time, and I would see that the incorporation of new practices on farm will likely draw a stronger correlation to agribusiness strategy as well. A huge catalyst of that would be if the consumer had a pull on it. We hear all these buzzwords of traceable products and sustainably grown products. We all know the ultimate catalyst is if the farmer's going to get paid higher ultimately by the consumer paying more. So that has improved in the last 5 to 10 years. Probably didn't exist whatsoever 15 years ago. It's probably going to get stronger and stronger in the next, few years and hopefully continue to pick up steam, because I think that consumer pull is the most powerful element there. A bank can play a role to try to make those things happen, but consumer dollars speak the loudest.
So as you're looking at one, and as we look to start kind of wrapping things here too, but as you're looking at the future of working with these farmers and what's coming down the pipeline, how are you factoring some of these things into that long-term planning, especially around like carbon, for example? Are you able to really factor that into that? And how are you guys factoring in the price of carbon? Any things that you're looking at there in terms of what that carbon is going to be worth, a couple of years down the road? Any insight on that?
Totally. We're still really early in that process, to be very honest with you. And I think the lending industry overall is. You have a few one-off lenders or CPG companies that are going heavy into the research of these carbon markets to see what the potential revenue streams could be from it. I'm cautiously investing resources and being on top of that. Because I think if these are established in some way, shape, or form, the bank certainly could play a role there. At the same time, I guess side off, I certainly have seen what has happened in other countries and see the upside and the downside to this. Where what could be interesting would be this dilemma that occurs where if a carbon market's created, I want to do everything in my power to make sure that value can stay inside the farm gate as best as possible. I would hate to see some sort of middleman come in there and not manipulate the market, but essentially buy credit or offer low prices for credits inside the farm gate and then sell them for high prices outside the farm gate. I think this has to be designed in a very win-win situation for all. And when it comes to inside the farm gate, that's an intricate decision. You need to make sure that practice is going to ultimately generate higher revenue for you. You want to make sure that you're not selling those credits for nothing, and make sure that this really is a long-term decision, especially if you have to change equipment out in some shape. I'm optimistic about that market potentially coming it's, the lender's role in there. I'm still kind of playing that out, to be honest with you.
Any hot take on some of the political side of this, on the Growing Climate Solutions Act or the Carbon Board, or setting up like carbon on the Board of Trade? What's your thoughts on that, I guess, from your standpoint?
It could happen. Then you are opening yourself up. If it's that publicly offered, you're opening yourself up to speculation on the carbon market, which I have a hunch could happen right out of the gates. We kind of see that with like RINs, for example. But from a political stance, I don't know where that could go. My jury's out on that. I wish I had a good take for you, but I get cool takes right now on that subject.
Anything else kind of to leave us with, or word for our listeners here?
One other thing I just quick hit on is the size of farm operation really shouldn't matter when it comes to banks and lenders. We get asked that pretty often. A bank of Bremer's size, are you really just focused on that top 10% of farm size operations? The answer is absolutely not. And I really don't think any other banks play that game. They are focused, and we are focused on the small farmers eventually do become the large farmers, because the large farmers do eventually turn over and morph into something new over time. So we really love working with small farmers, just like other lenders out there. So there's really those small farmers, especially forward-looking ones that can make use of new ag techs. Those are good customers. Those help decrease risk. Makes it a little easier to take on the really small ones. It's fun.
I'm debating on asking another question on
Do it.
death. Okay, so what's your quick hot take on death tax and capital gains taxes there, and how, my hot take seems like that's going to ruin the family farm.
Shouldn't have done that, Mitchell. I didn't mean it when I said do it.
I did it.
That's whenever those types of major tax issues pop up, especially with new administrations, my stance is really, it is a heck of an excuse to go in and talk to your succession planner in some fashion. If you're a farm operation, you don't have a succession plan in place. Let me rephrase that. If you are a business owner of any sort and you don't have a succession plan in place, just hearing us talk about this is an excuse to go in and talk. There's nothing wrong with talking about that. If you've gone through this with someone else that's passed away, it's not necessarily a fun circumstance that adds a lot of extra stress to the situation. But it doesn't have to be death. It can be just retirement. So could there be changes? Absolutely. Would it be detrimental to the family farm if some of that death tax stuff changes? It certainly could. Since I'm not a financial advisor myself, my advice would be go in and talk to one and try to get your ducks in a row and position your assets in a way that can be as protective as possible. There are different ways to do it. And what makes it kind of hard is that every situation is truly different. And that's why it's really hard to come on and just give some advice that would be overarching, important to everyone. That advice is go talk to someone. That's all I can say.
Zach, I was just going to say, we were talking about profits and yields earlier and how, never heard of that. Well, Mark just said something about farmers retiring. I've never heard of that either.
Yeah.
But it sounds interesting.
It does. That's even more rare than profitability.
You retire and
That's
then
true.
you come back to being a hired hand just to run the combine. That's it. You got to know how to work the thing. But yep,
that's called living the dream.
That's a fact.
Exactly.
That is it for Fieldwork today. Our show is produced by Annie Baxter with a lot of help from Lori Stern, Amy Mayer, Mike Langseth, and Corey Suzuki.
Kristen Schmidt helps us out with social media, Ellie Lyons does our marketing, and Lauren Humper is our project coordinator.
Thank you to all the technical directors at American Public Media who help us record and mix the show. Be sure to check us out on social media where we are at Fieldwork Talk on all the usual channels. And of course, we would love it if you wrote us a review to help others find us.
Don't forget to leave us a voicemail, call in with your comment or a question at 651-228-4810. That's 651-228-4810.
Thanks for listening. We will catch you guys next time.